Yeah, I mean, certainly look, the bond market's come a long way in a short period of time. If you just go back to April, we had a 2-year that was touching 5%. We rallied almost 150 basis points from since then. And I think you have some investors out there saying, hey, did I miss the rally? Is it too late? I think the way to be thinking about this for long-term investors is to think about where neutral is for the Fed. And also, will the Fed actually go through neutral at some point? It's very hard for the Fed to actually execute a soft landing. When you look at the economy, we've seen it slowly deteriorating over time. The labor market's been slowly weakening. I think there's a very high probability that when the Fed's done this cycle, they're not going to end at neutral. They're going to end through neutral. So I think that there's still plenty of value in the bond market despite this rally we've had. And the other thing bond investors have, the nice kind of tailwind they have, is that when inflation subsides like it's done, bonds actually act as a hedge on that risk portfolio. Again, this is something we weren't seeing in 2022, but now that inflation's come back close to the Fed's 2% mandate, those will perform in kind of inversely to the risk markets. And so that's something that is a nice tailwind for your kind of balanced portfolio.
Do you think that the Fed was too aggressive in starting with a 50? And do you think that the bond market has behaved in the way that you would have expected it to?
No, I don't think the Fed was too aggressive at all. I think actually the easy time for the Fed is when they're so far from neutral like they are today. So they cut 50 basis points. They know they're still well above neutral, but they're not really feeling their way in the dark yet. They want to get kind of, if they could snap their fingers, they'd like to be a little closer to neutral, given what's happening with the economy, given what's happening with the labor market. They just can't do that, given they were just kind of fighting about with inflation and kind of regaining credibility there. So I do think the Fed was justified in doing 50 basis points. I think they'll be justified in doing another 50 basis points right after the election if they decide to do that as well. And I don't think markets should be surprised by that. I think it's ultimately going to come down to the next two labor prints. If we get weaker labor prints, you better expect the market to kind of price in that 50 basis point cut. As for the market's reaction, we've actually seen bonds sell off a little more recently. I don't think that's a surprise. I think it's never going to be a kind of smooth ride where rates rally every single day here. And so I think ultimately you're going to see, kind of ebbs and flows in the market and little pullbacks here and there. But ultimately, if the data continues to weaken from here, you'll see bonds continue to rally and then the Fed to kind of price in a more aggressive cutting cycle as well. I think you can ignore the dot plot out 12 months. Ultimately, it has very little value. And that's the Fed's, if they have this kind of smooth soft landing, that's where they would end up. If they don't have that and the data weakens more, they're going to go much more aggressively.